How many small businesses in the world are scratching their head about VAT? I think there's lots. So follow my video and I'll explain all of the updates that have come in 2024. Our mission is to help business owners exactly like you. So if you're new, click the bell to make sure you don't miss out on any of our best pieces of content. So running a business can be really hard, and that's without putting VAT into the mix. So this video is to help small business owners exactly like you to make sure that you're staying up to date with VAT as we stand in 2024. VAT is basically a tax on consumer expenditure. It's whoever the final user is, and if the item's VATable, you are going to be paying VAT on this amount. In other areas of the world, they call it a sales tax. In essence, they are both exactly the same thing. VAT is collected by the businesses that are actually VAT registered. They charge VAT on their sales and they collect this on behalf of HMRC. It is very common for these businesses to pay over their VAT quarterly, although it is possible to do monthly returns, but that normally happens when businesses are getting constant refunds. Now, as of the 1st of April 2024, the VAT registration limit was 90,000, and in its most basic terms, that will be on a rolling 12 months basis. So on a rolling 12 months, has your income exceeded £90,000? If it has, you will need to register for VAT for your business. The only way out of this is if it's a one-off or your service that you supply is an exempt supplier. An example of an exempt supplier is a financial services business that is just completely excluded from the realms of VAT. But there is no threshold for a voluntary registration. You can register for VAT the moment you start in your business, way before that you hit the 90,000 mark. Now, the reasons for this could be a few. So it could be that you've got a big initial wodge of capital expenditure you need to pay that's VATable and you want that VAT money back. 2, you're expecting to become above 90,000 within the first year. So I've got clients that like to throw that gauntlet down on the floor to say, right, I'm going to get to 90 grand, so I might as well just VAT register now. That way I can have the systems, tools and procedures in place. So when I get to £90,000, I'm not worrying and looking over my shoulder. I'm just concentrating on making my business better. There are a few different tax rates for VAT. The most normal one and the standard rate is 20%. Now, I remember back in the day when that was 17.45 or 15, so just be mindful, these can change. But you've also got a VAT rate of 5%, which can be on a conversion. If you're converting a property, it can also be on light and heat as well at the same time. You can have some VAT that's charged at 0%. You go, 0%? What's the point of that? Well, there are certain services that are zero rated. An example will be a property developer that's building a house from scratch. That supplies zero rated. That means they don't charge any VAT on when they sell the property, but they get full relief on the VAT for expenses that they paid. You also get another type of tax rate called exempt, where you charge at 0%. Now, the thing to be mindful about this is all of your income and all your expenses from an exempt business is just ignored completely. If it's zero rated, you are able to reclaim back the VAT on your costs. Now, there's set definitions of what businesses qualify for each of these VAT rates. You just need to make sure that you've got the right advice and make sure that you're being legal. So going forward, if you have a VAT inspection, you are not going to get caught foul for not charging enough VAT. So the VAT can be described in two things. The first one is output VAT. Your output is all the VAT that you add to your sales. So all of this will be added up on your accounting system. So every VAT invoice, let's say it's £1,000 plus VAT, which will be 1,000 sale, 200 VAT, 1,200 payable by your customer, that's recorded in your accounting system. Because what you have as well is you get to knock off your input VAT, which is all the VAT that's on expenses. Now be careful, to reclaim back VAT on costs, you will need appropriate invoices that support these. Otherwise, the VAT is not claimable. So you'll collect all the VAT that you've got on your sales, you'll less the VAT that you're allowed to claim on your expenses, and that will be the VAT that's payable over. Normally, for most businesses, this is done on a quarterly basis. When you are preparing your VAT return, you've got a question to answer, which could be, am I going to do this on a cash basis or am I going to do it on an invoice basis? The majority of small and medium-sized businesses will do it on a cash basis. That means when they physically receive it. Because if you've got your customers that owe you a lot of money, your debtor days could be 50 to 70 days, you're going to have to fund that and pay that to HMRC before you receive the money. So it's really common, especially for businesses that we work for them to do the VAT returns on a cash basis. There are some exceptions to this. One of them is normally in construction, where if they've got a big project where all the costs are front loaded at the beginning, they may be paid slightly later. It could be beneficial for you to do the VAT on an invoice basis. But what you need to do is do a proper calculation and really understand your business cycle to see what works best for you. Because we all know cash flow can be the death and also life of most businesses, especially small to medium ones. If you have a VAT return date that's any date through the year, you get 1 month afterwards to be able to file that VAT return to make sure that you don't get any penalties. But you also get another 7 days to actually make the payment. So make sure that when you are doing your VAT return, you're making sure that you're hitting those deadlines for both the return and the payment to make sure you don't get any unnecessary penalties, because these are just a waste of money, and even worse, they're not even allowable for corporation tax too, but the interest is. But the penalties will be more of the significant fine, and all you're doing is just burning your money. So make sure you don't get to fall into this trap. An easy way to get around this is get your VAT return done by the 14th or 15th. Make sure that you've got any stray invoices coming, make sure everything's reconciled, make sure everything's put in the right spot. Get your VAT return done on the 15th and either have the payment come out on direct debit so you don't have to do anything, or if you don't trust HMRC system, which we've got a few clients like that, make sure you then set a payment on I normally do it on the 5th to allow a couple of days for any late recognition, so you don't hit any penalties on your VAT returns. I hope this video's really helped, but if I've got any questions that I can help with, just book a call in with me on Zoom. I'll take on board any questions you've got and help as much as you can. We also have a book called 70 Plus Ways to Pay Less Tax. They're all really good and they're all really exciting. Download your free copy today. The link is below.